What is Dakota Research? It's a brand new user interface focused on helping due diligence analysts manage the enormous amount of information around private funds, new funds in the market, funds currently fundraising, all the Form D information around funds, Form ADV around fund of funds. There's so much information. We've built in CRM-like capabilities so you can enter in all the investments that you've made and you can follow those. That means anytime there's a change to that fund or that firm or portfolio manager leaves, you get an alert at 5 o'clock each day. You can enter all your investments, all your call notes, you can enter your proprietary contacts, you can enter anything you want, just like a normal CRM. Then you can run reports. You can run existing investment reports, and then you can run prospective investment reports because you can create opportunities against the funds that we have in the database. And if for some reason we don't have a fund in the database, you can add one. So it's basically a tool that allows you to manage the enormity of this information, of which we're doing 99% of the work, and we're just giving you a place to go view that information, read the information, and then enter your own information against that. You can enter contacts, you can enter accounts, you can enter funds, most of which we're already going to have. And then what we do in the background is attach all this additional information to those funds as time goes on. When there's news, when there's events that happen, it gets attached. So we're doing all that in the background for you. Then you can use this as the place where you view, track private fund information. As I said, new funds that are being formed, first closes, final closes, all that type of information without having to lift a finger or enter anything. The only thing you enter is you create opportunities, you can enter your call notes and your contacts. So if you want to book a demo, go to dakota.com and you can book a demo. It's an unbelievable platform. It'll save you so much time, and it also allow you to uncover new investment opportunities. Go check it out. What is up, everybody? It's Guy Costin, founder, CEO of Dakota. Welcome to our 20th episode of the Emerging Manager Growth Show, joined by my colleague, Tim Dolan. Tim, thanks for being here.
Thank you.
For those of you that are new to the show, this is where we share key insights for emerging managers. And this show is always born out of all the questions that we get from people on our platform, information, wanting to know, hey, I'm a smaller manager. What are things that I can be doing to better market and sell my strategy with limited resources, or you might be smaller or what have you. And so throughout this, we debunk the myths. So for those of you that might be the first time watching the show, who is Dakota? Just a quick overview. We were founded in 2006. We've been a third-party marketer for about 5 investment firms since that time period. We raised over $25 billion. We really understand fundraising. We have a very structured process called the Dakota Way. And then in 2019, we took the database that we used to raise $25 billion and we turned it into a business. And now we have over 1,400 investment firms subscribe to our data. So we supply LP data, if you will, due diligence analyst data. It's all publicly available that allows investment firms to reach out, introduce themselves, and book meetings with new potential investors. So we keep over 1,400 investment firms, CRMs, up to date in real time with a lot of other additional information, but that's a topic for another day. So, Titols, welcome.
Thank you.
You as a fundraiser, we always like to kick off this show before we get into some of the details, because today we're going to discuss banks and broker-dealers and how emerging managers should approach them, which are really, really good sources of capital. So talk to us about what you're seeing right now in the fundraising environment.
Yeah, it's exciting. I mean, obviously we're halfway through February, which is hard to believe. January went by pretty fast, but it was active. Meetings are happening. Allocators are taking meetings in the office, kind of back to the boardroom, suit and tie, which is fun.
Yeah.
Still a lot of Zoom conversations as well. The search activity, I mean, we see it from Dakota Marketplace and the consultant-driven searches, but even in conversations, money's in motion. People are, again, taking meetings, making allocations. And I think it's all across all asset classes. There's not really an asset class that isn't being talked about.
Circle back for everyone, just as everyone's kind of listening and what's really going on. is that you came out of 23 and everyone thought things were slow. Then you have, how would you characterize 2024?
Yeah.
Like things got back. And then do you see the search and just activity, that momentum just continually increasing?
Absolutely. And even with in the equity markets, a great performance largely last year in 2024, there's a lot of dispersion within asset classes, right? So whenever that takes place, right, whether it's active, passive, it really doesn't matter, right? There are changes being made, which, right, is client service is a big component of it, right? Maintaining those assets, which is a lot of time and activity, but also because of that dispersion, there is search.
Right. And so us always working with emerging managers, Edgewood back in 06 was definitely an emerging manager, Hamlin in 2010. Most recently Spruce, which is a private credit strategy that we've been marketing, our team has been marketing. Talk to me about the things that we've been doing with Spruce and the successes, the success that we've had. So we're just not here in the ivory tower, right? 2 years ago, Spruce, we started right from the ground, if you will, and built up from the ground up.
Well, yeah, exactly that. Built it from the ground up, and it takes time, right? And just that repeated process of being in front of the right subset of buyers for the strategy. We're going to talk about banks and BDs today. That's a great channel to hit for any asset class, but specific for Spruce, right? It's the onesie twosies, right, in the early days, and that's what we always harp on, is just kind of get those little wins. They pile up, right? And if you're an emerging manager, smaller, newer, right, those onesie twosies, they add up and they really help build that track record. So when you get to 5 years, you have that asset base.
Yeah, and I think the advice that we're going to give you as we go through this is that this is a really, really hard job. If you're an emerging manager and you're trying to figure it out, you're trying to get lift, the only way to get the lift is to get face-to-face with potential investors. Even though today on the docket, we're going to talk banks and BDs, past episodes talk about, we highlight RAs. I'm going to tell you right now, in order to win for an emerging manager, if you're 100 million, 500 million, $1 billion, you have to go to the RAs. It has to be part of your DNA on a daily basis, is calling on the RAs. And RAs are very receptive to taking meetings. They're very receptive to new ideas, and they're always looking at new ideas. It's really, really a critical component of their business, is finding unique and interesting investment strategies. We've talked about it quite a bit. However, it's hard because it's onesie twosie, right? It's one at a time, as you said, Tim, and it's using city scheduling to actually do that. So with that, let's kick it into the banks and broker dealers.
Perfect. So a couple things, just thinking about the bank and broker dealer channel, maybe just start with a few myths that some people might think about whether it's the wires, the banks and the BDs, right? Some people are saying, well, I reach out to them and I need 500 million in assets, right? Or 100 million or 200, whatever it might be, or call me back when you have a 3-year track record. Or a small team, I can't wholesale into these bank and broker dealer platforms, right? What I would say is fair, right? Fair comments that you'll probably get, but you need to start the conversation today, right? So when you do have that 3-year track record or that 500 million in assets, right, that due diligence process has already begun.
Yeah,
right.
So, and I think it's important as we start to characterize the banks and broker dealers. If you have a long-only strategy, most banks and BDs have a variety of different platforms. They have separate account platforms, they have mutual fund platforms, ETF, UMA. They have private fund platforms for private strategies as well. And making sure that you know who the analyst is at each bank and broker dealer. And we always like to think of the parallel track, right? The RAs will be your bread and butter, day in and day out. They'll do the onesie twosies, 2, 5, 10, 15, 20 million. Most members of our platform, of our database, Dakota Marketplace, have approached it in a very similar way. And there's always a handful of RAs that give you the lift, get you out of the gate, sort of put you in business. However, if you can get 1 to 2 platform wins a year, maybe 3, like I said, regardless of your strategy, but you just need to know who the analyst is. And there's a variety of different platforms, and they're always on the lookout for new and interesting strategies. So we have in our database the breakdown of every single bank and broker dealer, their platforms, where the wins lie, who the key contacts are at those banks and broker dealers. But it shouldn't be seen as your primary. It should be seen as a complement to the discretionary capital that RAs, multifamily office, then of course family offices have too.
Absolutely. I mean, these are large pools of capital that allocate across all asset classes, all types of vehicles and strategies, right? So mutual fund, SMA, UMA model delivery, LPs on the private side. So just a few other considerations when thinking about the banks and BDs, right? That vehicle accessibility. I do want to call out on the long only side, the UMA model delivery seems to be pretty popular amongst the banks and BDs.
And Tim, walk us through what UMA is.
Yeah, so a separately managed account, right? The asset manager has the assets and they're trading the portfolio on behalf of that banker broker dealer. Model delivery, though, is effectively just a technology way where you send trades at the end of the day, and then that platform, they trade on behalf of their client.
And UMA would be a win for long-only managers.
Yes, exactly. Primarily, yep. And the largest UMA technology provider out there is Envestnet, right? So that's something to keep in mind if you are talking to these banks and BDs. SmartLeaf is another one, Adhesion, SmartX. Other things to think about with the banks and BDs, there is some consultant usage in their research process. It's not widespread, but just a few that have varying levels of consultant usage. Merrill Lynch.
Yeah, it makes sense, right? Is that in order to get some leverage in the system, and they're looking at so many ideas, is that they end up hiring a consultant, right, to do the due diligence on these different firms that they're considering.
Yeah.
And so you're going to walk through a few. So that's really the banks and VDs hire a consultant, right? There's a very specific mandate of what they're going to do for them. They already have the research. They have the research team. They can cover a lot of ground. And it's just a whole area where a bank and BD doesn't have to staff for. And they're delving into that expertise. And they can also use that consultant as a brand,
Exactly,
if you will, representing to their financial advisors, say, hey, that we've used Mercer or Callan as our consultant to vet these different funds, and these are ones that we've gone through and they vetted and then we've approved them. So I want to talk about how that all works.
Well, you hit on a couple of them, Mercer and Callan, right? Mercer works with UBS. They also work with Case, the alternative TAMP provider as well. Wilshire, Fiducian, Goldman Sachs and Rocaton, Siegel Marco, Conway, which is a OCIO out of St. Louis, primarily working with some smaller bank trust platforms. But again, Merrill Lynch, some level of consultant usage. UBS, like I said, uses Mercer to some degree. Raymond James, Cetera, Stifel, right? So these are all at the same time of hitting the consultants and the RIAs and the banks and BDs, right? You're kind of hitting multiple channels at the same time in these conversations, which is pretty.
Yeah, and let's just talk about that, because really a lot of times these consultant, if you're trying to get on a consulting platform and be an approved manager, is an extremely long road.
Yep.
But if you're doing it in conjunction with getting on a BD platform and the internal team likes you at that bank or broker dealer, it makes that conversation with a consultant, number one, you get in business with them, you get familiar with your strategy, and sales cycles are shorter. I always think of a true consultant select list. Sales cycle for an emerging manager can be 10 years.
Yeah.
This can be much shorter.
And just the other thing to keep in mind with the banking broker dealers, even if it's the wirehouses or just a firm like Cetera or Raymond James, right? Absolutely hitting home office research to get your strategy approved in a select list and a model, that's the win. But at the same time, hitting the underlying advisors and teams, we would highly suggest doing that. Some of the larger teams, right? Because what you're doing is you're forcing obviously the top down from research, but bottom up, these teams can force demand, right? And they can call in and say, hey, I like this strategy. We're good for 10, 50, whatever it might be. And that's a way that could help hopefully expedite the research process as well.
Our advice to you on how to think about the banks and broker dealers from an execution perspective is you have to be able to have an answer. If somebody asked you, where do we stand with Raymond James? Where do we stand with Merrill Lynch? You don't have to be on the platforms, but you do need an answer. You do need a strategy. But I would always separate out the wires, make that separate, because those are bigger situations between Merrill, UBS, Morgan Stanley, and Wells Fargo. And then look at the banks. You just have to have an answer. You have to have an answer. Where do we stand with Cetera? Where do we stand with Raymond James? Where do we stand with PNC? So on and so forth. So just make sure over the course of time that you can't just be, I don't really know anyone there. I haven't really tried to call on them. In my opinion, as an emerging manager, you're making a big mistake because you probably have a very good strategy. They want to hear about it. You're not going to know what analysts with your strategy might really appeal to. So you have to have answers for all the banks and broker dealers if you're and I know you are very serious about growth.
Yep. Great.
All right. So let's kick into some fundraising best ideas.
Perfect.
So as we're talking about execution, right? Tim, one thing that we talk quite a bit about is what is the most efficient way to get focused, okay, and make the fundraising process much more systematic. And that's what we've tried to do at Dakota for the past 15, 18 years is how do we make the sales process much more systematic versus opportunistic? And we do it through city scheduling. So do you want to talk about sort of the intent around city scheduling and sort of the why behind how we do it?
Well, the city scheduling it's a coverage model, right? So if you're calling on the RIAs or the banks and broker dealers, right, even in Chicago, that's close to 150, 200 accounts, right?
Yeah.
As an emerging manager, maybe one salesperson, 2 salespeople, just that one city, that's a lot, right? So what the city scheduling does is it provides focus on what you're doing that day, right? I'm scheduling for Chicago on February 11th, and here are the targets, and it's a reach out. And we talk about the email, right? Very tight subject line, meeting request, the date, very specific. And we have this in the follow-up, the template, specific call to action. Can you meet at 11 a.m. on February 11th?
Yeah, so the whole concept behind city scheduling, the reason we did it is that this whole business was very, very difficult and you really can't raise any money without getting face-to-face with people. So you have to be booking meetings. In order to book meetings, you have to send cold emails. And in order to do that, you need a system. And the system we call city scheduling that we recommend internally, and we recommend it to you. Always have 5 cities that you're scheduling for at any given time, because you do have to resign yourself to the fact that you're a professional meeting setter upper. There's no way around that, especially as an emerging manager. And if you can have this level of discipline, we have seen it time and time again. The people that are the most disciplined to the city scheduling, always having 5 cities, always doing your 20 to 25 asks a day, have gotten the results. And that's really how these emerging managers get off the ground. And if you want to get off the ground faster, stay disciplined to the city scheduling. As Tim was just mentioning, and it's worth repeating, Tim, we talked about the subject line, meeting request in the subject line, date and time, very important. Work very hard on your 1 to 2 sentences of describing who you are and what you do and why they should care to take a meeting. Then close it out with a clear call to action. Can you meet February 11th at 9 a.m.? And a lot of people like to sort of maybe get pushback on, well, I'd like to provide a few different dates, times. I review emails all the time. Conventional wisdom is not what you want to follow here. You really want to listen to what we're saying, because I promise you it works. We do it every single day. So many of our members of Dakota Marketplace that are members of our platform use the exact same approach with a high level of success, because it just gives you more reps. And you can't get discouraged when people don't respond to you. Tim, let's talk about my favorite, right? Follow-up. So we get this question a lot, is that I get the meeting, I do the meeting, what's your follow-up cadence? And Tim, how do we characterize follow-up?
Follow-up happens in the meeting.
So follow-up happens in the meeting. And for a long-only manager, what do you mean by that?
Well, it's just asking the straightforward questions at the end of it, right? It's effectively, where do we stand? Right. And if it's long-only equity, you wrap up the meeting and you're looking at the allocator and it's like, do you believe this is a strategy that could fit in your asset allocation?
Yeah, right. Critical, right? So just getting it out there, make no assumptions. And then if they say no for whatever, then you know what the answer is. You've gotten your quick no and you're onto the mailing list, because you don't want to come back to the office and say, oh, we had a great meeting, but there's no real next step. So if they say yes, then what?
Then it's, all right, do you believe you're going to have a search in this asset class in the next 9, 12, 18 months?
So you have to kind of ask for the order to be involved in a search. Hey, you're going to do a search. And if you are,
you are, then it's okay.
Get involved.
Can we get involved in what are the necessary next steps from a due diligence process? Do you need to come on site? Is there a DDQ we should be working on? Right. And it's very similar on the alternative side. It's even more straightforward. Can you meet the final close of December 31st, 2025?
Yeah. And what I will tell you is that everything we go through in our Dakota way, everything, okay, is unconventional, okay, requires discipline, It also can sound very elementary, right? You have to have a beginner mindset, right? Learning, but these things really work. And I haven't seen anything out, maybe relationships and stuff like that, really work. So save yourself the amount of time that if you're going to do a meeting, okay, ask those 2 tough questions. If you have a private strategy, it's kind of the same. It's just a different. Last question is, hey, we have a final close on 6:30. If there's interest, do you think you can make that close? Then if they say yes, then you're going to ask them the questions of,
It can feel a little uncomfortable at first, but you're actually doing yourself and the allocator a favor. They're
Yep.
appreciative by these straightforward questions, right? Because now, if it's not a fit, now you're not spamming their inbox with something that they don't really care about, right?
Yeah.
We're just all on the same page, and it's level set.
So you have your city scheduling, you have your email template. You ask the 2 tough questions in the meeting. These are all key leverage points. We're going to leave you with 2 to close out. One is going to be the use of a CRM. So Tim, we've obviously built our entire business around the concept of a CRM.
Yep.
We happen to love Salesforce. It just is very flexible. It's extremely robust. Being able to store the meetings that you've scheduled, the meeting notes, and then your pipeline, your opportunities is a fundamental game changer.
Absolutely.
Right, because it's really the only true leverage point that a salesperson has to be able to do quick recall. Because you really want to be able to look at all your past activity, i.e. meetings that you've done.
Mm-hmm.
And so you can review those on 90, 180 days, 9 months, a year. Who have I met with? It's going to trigger sales actions.
Yeah.
You're not going to have to then think, and you want to be able to recall that information with 1 or 2 clicks. What you don't want to find yourself doing is going through Excel spreadsheets, yellow pads of paper. It's just you're not going to get that 2, 5, 10x productivity bump.
Yep.
If you don't use a CRM. So all of this information will be in the show notes, but we strongly, strongly recommend, and we have very clear tactics around how to configure your CRM, which will also be in the show notes. To close out, Tim, we love and have forever the quarterly webinar. And the reason the quarterly webinar is so powerful is that we end up asking for meetings. That's kind of the email cadence.
Yeah.
If you're inviting somebody to a webinar to hear something interesting about your strategy that happened during the quarter, because you're going to give an update, number 1, you should be doing it for your clients. Number 2, for the prospects, you send 4 emails, a save the date, an invitation in the middle, and then the day of. All this will be in the show notes. And then you do 20 minutes prepared remarks, and you walk through the slides to educate and update both your clients as well as your prospects. And then they're going to see that and see your brand over time as an emerging manager. The more insightful you are in your content, and we have a really nice ebook on how to create a quarterly webinar, the more insightful you are, that then draws you back to your investment process about maybe an investment that you've made recently, any insights that you can provide, educates, if you will, the listener, the due diligence analyst that you're targeting. And then, out of complete respect for the due diligence analyst, you send the replay, you transcribe, and then you do an abstract. So you have 3 ways that they can consume the content, which is 1, a replay, 2, the transcription, and then 3, just bullet it out. If they can't get to the whole thing, hey, this is what we covered. It's going to delve deeper. You can go in the transcript, or you can watch the webinar.
It's client service, as you touched on. It's free marketing for the most part, right? It's a time saver for portfolio managers, right? To do a webinar that hits the masses, right? Rather than having to do maybe 15, 20 calls. But also it's a due diligence tool as well. Analysts do go back and say, hey, can you send me the last 4 quarters webinars?
Yeah.
And they watch them and they read them, right? So it's a way to look at their
big part of due diligence. Yeah.
Big part. So
Okay, next.
can't recommend it enough.
Right. Yeah. As we are wrapping, Tim, we got the book done.
Congrats.
Yes.
I didn't even realize you were doing that.
Yes.
Tell me about it.
Yeah. So the Dakota Way book,
Oh,
we
wow.
finally, nice, Jamie.
I like it.
We completely codified our approach. It took a lot longer than I anticipated writing this, even though we really knew everything. Reason being is we wanted to make sure it was really in my voice, if you will, of how we describe this on our Rainmaker series, everything we describe internally. So we've codified it. You can get it on Amazon right now as a Kindle. You can also buy soft copies, if you will. All the proceeds and revenue and everything are going to our charitable arm, Dakota Gives. And so it basically distills down the 4 core principles of the Dakota Way, everything we've been sort of coaching here in the Emerging Manager Growth Show and on our Rainmaker shows to really help investment salespeople. Because as you know, Tim, we're like our industry from a sales perspective, there's not any training, right? You can't go to a training course, if you will, especially as a boutique. This is as close as you can get. So we put it out there. We wanted to make sure, at least in our opinion, I like to think of the Dakota Way as a jar we put in the rocks and the pebbles, and then the salespeople put in the sand.
Yeah.
Because everyone has to have their own personal imprint that they put on their sales process. We're giving you the rocks and the stones, the really big core rocks to follow that we know work time and time again. And that's what the Dakota Way is. And that's really what we talked about today on the show.
That's amazing. I mean, obviously I've been working with you for 13 years and then learning this. How long have you been working on the book?
It took a long time. This is 2 years of work, procrastination, trying to because you get a ghostwriter, it's not quite in your voice, but we got through it and we grinded through and got it to the finish line end of last year. So it's finally out there. It's on Amazon as a Kindle or a paperback. And we also can send you bulk copies. And you can just reach out to me, guy@dakota.com, if you want us to send you bulk copies for your team. So with that, Tim, that concludes episode 28 of the Emerging Manager Growth Show.
Appreciate it.
Episode 29 will be on March 11th at 1 o'clock. Everyone, thanks so much for joining. All the details will be in the show notes. Have an awesome day. Hello, everyone. I just wanted to say thank you for watching the Emerging Manager Growth Show. I hope you got a lot of value. And I think, as you know, we shared an enormous amount of information about metro areas and other type of information, RIAs, etc. All of that information exist in Dakota Marketplace. And if you're not a member, we would love to show you the platform. Just simply go to our website and get a free trial of Dakota Marketplace.